We got to start with the big thing here, net interest income. We see the forecast for a decline when it comes to the regional banks. I want to ask you, what are your expectations? You are a shareholder of a number of regional banks. And also, is that already priced in? We just mentioned regional banks underperforming since the rate cut.
Yeah, I mean, it's tremendously priced in. Whatever discount metric you want to try to use, price to book, price to earnings, they traded at all-time discounts to the S&P 500. And the other thing that's really interesting is if you do a price to book ratio, do it again after they report, because the book value of these companies is going to be way, way up. Because a lot of these companies bought bonds, when the rates were zero, and obviously they got hammered on the valuation of those. Obviously, with the rates coming down, they're going to get a big gain in terms of where they were marked. And it also makes mergers and acquisitions a lot easier, too. And I think, that train is leaving the station. We've seen a lot of, transactions start to happen now.
So I know you're expecting more M&A when it comes to the banking sector. I want to get to that in a moment. You hit on something a lot of analysts are talking about right now, the fact that regional banks are trading at a discount to the broader market, but also a discount to their historical averages. Wedbush put out the numbers that regional banks are trading at about 11 times forward earnings. Historical is about 13 times forward earnings. So in your mind, are there deals in the regional the bank space right now, despite the fact that net interest income may be under a bit of pressure?
Well, I mean, first of all, it's a stock picker's market. So there are banks that will benefit from rates falling. Their margins will actually go up. I mean, the biggest banks, obviously Bank of America, actually will make more money as rates fall. So, there are examples out there. The smaller you get in size, the bigger the discount. And that actually makes that the place I want to be. It's why I don't know any of the big guys right now. Like the big guys, they're doing fine. But the little guys trade at such discounts, in many cases, discounts to book value, in many cases, single digit PE multiples, and they're takeover targets. I mean, so you've kind of got it all set up right now with potentially better earnings and certainly potentially M&A in their future. You're not going to have that in the bigger banks.
After Silicon Valley Bank, a lot of people call for bank consolidation. We haven't seen it so much. We've seen it in some very specific cases, but not so much. But again, you're calling for it again. I want to hit that commercial real estate risk. S&P Global is saying about $950 billion in loans are coming to maturity. They're also citing that sticker shock going from about 4% to 6%. How do you view that as a risk for the regional banks in particular? S&P also adds that only about 10% of these loans are supposed to be in the office space.
Yeah, I mean, the interesting thing is a lot of people were shouting from the rooftops that we're going to have thousands of banks fail. We've had none fail because of commercial real estate. So that's really important. Secondly, that statistic was the average rate of loans booked this year. Well, the Fed's given us some relief. Rates have come down. Treasury rates have come down. So, if there's a refi, it's not quite as bad. And also, exposure is very, very different if you go into the smaller banks. Their typical loan might be to a little office park where the building is, 2 stories and full of doctors and dentists that have to go to work. So they're paying their rents on time, and their cash flows will work in a lower rate environment for sure. And not all of it comes due at once. So I think that banks have put away a lot of reserves on this stuff. They've already paid it forward. On the bigger banks, companies like PNC have over 10% reserves put aside to loans.
Yeah, PNC reporting for the opening bell today. Before we let you go, Anton, I do want to talk to you about the big banks, specifically the 2 big banks that reported last week, and kind of get some insight on what you think might be a read-through to the banks reporting this week. I'm looking at the charts here. J.P. Morgan and Wells Fargo since Friday. J.P. Morgan up 4%, Wells Fargo up almost 8%, over 7.5%. That's despite their net interest income reporting not being ideal. I mean, I'm looking at Wells Fargo. They lowered their net interest income guidance. J.P. Morgan went out their way to say that their third quarter outperformance was a blip. Are we possibly over-indexing net interest income when we're looking at these banks? I mean, when I look at J.P. Morgan, their investment banking and fixed income trading exceeded estimates, and it seems like that's the reason why the stock is moving higher.
Well, I mean, the interesting thing is both of those are stories, right? And they're good stories. Wells Fargo may have its cap lifted on assets, and I think that's really important for future growth. So people are kind of looking at that. The earnings estimates came in slightly better than expected, even though they lowered some guidance. People expected that. So a lot of people were short both of those stocks. And, clearly JP Morgan has, under-promised and over-delivered, and they've done it again. They set the bar pretty high. But absolutely, those 2 companies will have lower net interest income than they have today. And their balance sheets are set up that way. They're good companies, and they're not very expensive, but people were short. They were set up the wrong way. And I think the other thing we've seen is we've seen some changes in the poll numbers, and under a potential Republican administration, banks in particular perform much better. If you look at November 2016, there was a giant pop in banks when Trump won. And simply it's because of less regulation.